This is Greg Mikulowski from FXDD, and this is a Forex commentary for FX Street, brought to you by FXDD. We're going to take a look at the gold falling below support at the 1196 level here in our morning or our daily commentary. And taking a look at I'm going to start off by taking a look at the daily chart here. And the 1196 is important only because in June and early July we had a low at that area. The low on this day right here came in at 1196.75. The low on July 1st came in at 1196.38. On July 2nd came in at 1198.25. Today we broke through all those levels here and started a move back to the downside, or further sharp move to the downside. The low has reached 1189 currently at the moment, and from a technical perspective, as long as the price can remain below this 1196 50-ish type area, that the bias is going to remain to the downside for gold, with a 38.2% retracement of this move up from the low of 2010, which came in at 1044, to the high of 2010, which came in at 1265 region. That 38.2% retracement comes in at 1180.63, and that would be the target on the downside as long as the price can remain below the 1196.53. Other levels of importance here for the year gold as a target include the 1170 level, which is where the 100-day moving average comes in. You can see that since the market broke above and closed above this 100-day moving average on this day right here, going back to April of 2010, the market has been below and stayed below, or stayed above, that 100-day moving average and closed above it. So it's not unusual to see a further move to the downside. So what's driving the market here? And today, and really over the near term, we have seen some weaker data in the U.S. We just had ISM non-manufacturing come out weaker than expected. Overnight, we had Swiss inflation come out weaker than expected. We saw the housing data out of Canada come out much weaker than expected, with building permits falling by 10.8%. Last week we saw U.S. Housing data come out much weaker than expected, and the unemployment data on Friday in the U.S. also came out weaker than expected. And we have to remember that the gold is considered a inflation hedge. It also is considered a store of a safety haven. And what we saw with the gold prices going up here over the last year, or through this year at least, and really going back longer term, of course, is that there has been a flight into gold, and a correction is certainly not out of order, given some more stability within the eurozone. Bank stress tests seem to be coming out okay, and so markets get overbought, markets get oversold, and seeing a 38.2% retracement just this move to the downside is not out of the question. Just as a guide, if we were to go back in time and take a look at this correction that occurred during from this run up in the market. The market came down and corrected to the 50% point. I'm going to get rid of this line right here. You can see that the market on this move to the upside corrected 50% of that move to the 1045 level. Now we move forward and take a look at the last leg to the upside here, and we haven't even gotten to the 38.2% retracement of this move to the upside. So it can happen. It will happen. Or not it will happen, but it certainly can happen. And we got the first indication of the break of the 1196 level as a guide that perhaps we have further room to the downside for gold. This is Greg Mikulowski with a Forex commentary looking at the gold for FX Street.